Hey everyone, welcome back to Corporate Decoder, the place where we break down the money secrets of big companies to see if they are actually making sense or just blowing smoke. Alright, buckle up because Pruco Life Insurance Company of New Jersey has dropped their latest quarterly report, and it is a wild ride with some very interesting numbers for you to chew on. So what is this document all about? Well, it's basically a check-in on how the company is doing financially during the last 3 months ending the 30th of September 2025. And let's just say they have been busy making some significant moves, especially with their investments, and how they are handling their insurance business. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Let's fast forward to the core of the matter, their financial statements. Now this table shows us what the company owns and what it owes at a specific point in time. Think of it like a financial snapshot. Let's look at their assets first, which are the things the company owns as of the 30th of September 25. Their total investments were a whopping $5.58 billion. That's a lot of money tied up in stocks, bonds, and other investments compared to just over $4.57 billion at the end of 2024. So investments are growing nicely, however, their cash and cash equivalents actually dropped quite a bit from $170 million down to $145 million. This can sometimes mean they are using their cash to invest more, which is fine, but it's always good to keep an eye on your available cash on. You think? Now let's talk about liabilities, the money the company owes to others. The biggest chunk here is policyholders' account balances, which jumped from about $4.9 billion at the end of 2024 to over $5.7 billion by the end of September 2025. This signifies a big increase in money they owe to their customers for their insurance and annuity products. It's like cuss. Tommers are trusting them with more money, but it also means they have more obligations to fulfill. And what about the company's net worth, its equity? Well, that also saw a healthy increase from about $1.25 billion at the end of 2024 to over $1.34 billion by September 2025. This is driven by a strong retained earnings growth and also a reduction in accumulated other comprehensive income losses, which is generally a good sign, meaning fewer paper loss as hurting their overall picture. Now let's dive into how they actually made money or lost it through their operations. Their revenues are a mixed bag. Premiums, which is the money customers pay for insurance, actually dipped slightly for the 3-month period and stayed almost the same for the 9-month period. This might seem like bad news, but it's a common thing in the insurance world, especially when accounting for changes in estimates related to future benefits. But here is where it gets interesting. Policy charges and fee income saw a huge jump for the 3-month period, going from about $21 million to $27 million. However, for the 9-month period, it looks like there was a massive drop from over $375 million in 2024 to only $69 million in 2025. This is a massive discrepancy and needs a closer look. It suggests a significant change in their business strategy, or perhaps accounting adjustments that dramatically reduce this revenue stream. Thankfully, their net investment income is looking solid. It went from $57 million in the 3-month period in 2024 to almost $70 million in 2025 for the same period. And for the 9-month period, it jumped from $158 million to $193 million. This increase is a testament to their growing investment portfolio and likely successful investment strategies. However, when it comes to actual realized investment gains and losses, it was a rougher ride. For both the 3 and 9-month periods, they saw significant losses. This means they sold investments at a loss compared to what they bought them for in 2025, compared to smaller losses in 2024. On the 3-month period, they lost about $40 million, and on the 9-month period, the losses were almost $156 million. Ouch, that is a major hit to their earnings. Now, market risk benefits can be a bit tricky. These are basically the costs associated with guaranteeing certain benefits on their products, especially the variable ones, and their hedging strategy aims to offset some of this cost. For the 3-month period in 2025, they actually saw a gain here about $21 million, which is a positive turn from a loss in 2024. But for the 9-month period, it was a smaller gain of $6 million compared to a larger gain of $10.5 million in 2024, so a step back there. And all these ups and downs led to a very different net income picture. For the 3 months ended the 30th of September 2025, they reported a net income of over $41 million, which is fantastic compared to just under $14 million in the previous year. But for the 9-month period, while they had a net income of over $31 million in 2025, this is a much smaller profit than the massive income of almost $60 million they had In 2024, wait a minute, did I miss something? Let me recheck that. Yeah, in 2024, they reported a net loss of about $59 million. So a net income of $31 million in 2025 is a huge improvement from that loss. That is a really important story point right there. Improving from a significant loss situation. Looking at their equity again on the 30th of September 2025, their total equity is at $1.34 billion, up from $1.25 billion at the end of 2024. So the company is getting financially stronger, which is always a good sign for investors and policyholders alike. Let's look closer at their investments. Their fixed maturity securities available for sale are a huge part of their holdings as of the 30th of September 2025. They had over $3.38 billion in these securities, which is a big jump from about $2.71 billion at the end of 2024. Importantly, they have set aside an allowance for credit losses of $472 million in 2025, a number that was zero in 2024. This indicates they are being more cautious about potential defaults in their investment portfolio, which is prudent given the market conditions. And where are these investments going? Mostly into US corporate public securities, totaling almost $1.8 billion in fair value for the value for sale portion alone. That is an aggressive bet on the corporate market. Their commercial mortgage and other loans also saw a significant increase from $477 million at the end of 2024 to over $672 million by September 2025. And importantly, they have an allowance for credit losses here of about $2.7 million, which shows they are aware of the risks in this sector. When it comes to their debt securities, especially corporate ones, they are deeply involved. And when we check out the fair value disclosures for these assets, they are using a lot of level 3 inputs, meaning these are harder to value as they rely on unobservable inputs. This can make their fair value reporting a bit more subjective, given the complexity, especially with corporate securities. Now, about those derivatives, they are using them to manage risk, which is a smart move. Their currency and interest rate swaps are a big part of this strategy. In September 2025, they had about $270 million in notional amounts for these, with fair value assets of $5.7 million. They seem to be actively hedging against currency and rate fluctuations, which is essential in today's global economy. Let's shift gears and look at how they are managing their policyholders' account balances, especially those with guaranteed minimums. The data here shows a massive portion of their fixed annuity business has crediting rates well above the guaranteed minimum, which is great for policyholders and means the company is likely performing well on those investments. But there is also a substantial chunk in the variable annuity and life universal life segments that are also performing strongly, indicating good market returns, benefiting those accounts. This section on net amount at risk for variable annuities is where things get really interesting. It is the guaranteed death benefit minus the account balance. And as of the 30th of September 2025, it stands at over $625 million compared to just over $582 million a year. Prior, this increase means the company's exposure to potential losses on these guarantees is growing. This is a key area to watch because if the market's sour and account values drop, then their payout obligations on these guarantees could become very costly, especially when you consider the net amount at risk for these contracts is substantial. The company is heavily involved in reinsurance, particularly with its affiliates like Prudential Insurance and PayU, and this is a huge area of their balance sheet, totaling over $5.68 billion in recoverables. As of September 2025, that means they are owed a massive amount of money from reinsurers, which is essentially money they expect to get back if a covered event happens. Looking at their revenues and expenses for the 3-month comparison, revenues increased significantly, but benefits and expenses also went up. This signals an active period of business operations for the 9-month comparison. It is a bit more complex. Revenues are down substantially, but benefits and expenses are also down even more dramatically. This pattern could be due to a number of strategic or accounting shifts that warrant a deeper look. Management is saying their total investments increased by $1 billion, and this is mainly because they are selling more of their general account annuity products. This makes sense as it directly fuels their investment pool and likely their future earnings. Similarly, their policyholders' account balances jumped by $0.8 billion, and they attribute this to more sales of their index products, which are clearly becoming a popular offering for their customers. This also means more future obligations for the company. But it shows customer trust. And now for my take on Pruco Life Insurance Company of New Jersey. Based on the numbers, it looks like a company that is active. Managing its risks and growing its business, their investment income is strong, and their equity is increasing, which are definite positives. However, the significant losses on realized investments and the growing net amount at risk in their variable annuity products are areas that require careful attention. They are making smart moves with reinsurance to manage these risks, but it is a balancing act. The big drop in policy charge is And fee income for the 9-month period is perplexing and needs closer scrutiny to understand if it is a strategic shift or a one-off event. Overall, Pruco Life Insurance Company of New Jersey appears to be navigating a complex financial landscape with a mix of successful strategies and areas that demand close monitoring. What are your thoughts on these figures and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Make sure to check out our Discord in the description below. Thanks for watching. See you next time.